and thank you for joining us for today's webinar. Before we get started, I have a few housekeeping notes. First, for the benefit of all participants, attendee lines have been muted. Should you have any questions that you would like to submit during the event, you may submit them through the question and answer space. If we cannot address your question during today's webinar, we will follow up after the program. Second, please note that today's webinar will be recorded and circulated to all registrants via email after the event. Should you have follow-up questions at that time, please reach out to any of the key contacts listed in the email. Note, Dentons can only issue CLE credit for attendance during the live webcast of the webinar. Participation on the live webinar must be on a computer or laptop device. Credit is not available for joining via a mobile device. Third, one other important note, if you have a New York, New Jersey, Pennsylvania, or Kansas license, please be sure to listen for the code word given during the program. When prompted, you will need to enter the code word into the Q&A section of the screen. If you don't have a license in these states, you can disregard this. Today, we will be going over how the One Big Beautiful Bill has changed the Opportunity Zone landscape by introducing what some are calling Opportunity Zones 2.0. We will walk through where the program came from, why reform was needed, and what has changed. Next slide, please. My name is Trey Bowling, and I'm a shareholder here in our Birmingham, Alabama office. Much of my practice focuses on structuring and planning for real estate and joint ventures, as well as their related tax matters, including economic development and tax incentives. I've been advising sponsors and investors on Opportunity Zone matters since January 2018, right after the rules were released. Today, I will be presenting with Andy Rankin, who's a partner in Denton's Indianapolis office. Andy focuses on real estate, public and private finance, and opportunity zones. Prior to joining Denton's, Andy spent 7 years with an industrial retail company with over 1,000 locations, where he implemented and operated their Opportunity Zone program at 28 locations. Next slide, please. For today's agenda, we will first recap some of the relevant OZ rules as originally enacted in order to lay out the groundwork for describing the Big Beautiful Bill's changes. Second, we will talk about why reform was needed. Third, we'll move into OZ 2.0 under the Big Beautiful Bill, what's new, what's gone, what's improved. Fourth, we'll address the transition period through 2026. And then finally, we'll walk through some hypotheticals to illustrate some of the changes made by OZ 2.0, and then wrap up with a Q&A session. Next slide, please. Recap of OZ 1.0. Next slide, please. Before jumping in, I want to highlight a few common acronyms for those who may be unfamiliar with the alphabet soup of opportunity zones. The most important of those being OZ, which just stands for Opportunity Zones generally, QOF, standing for Qualified Opportunity Funds, the investment vehicles, QOZ being Qualified Opportunity Zones, which are the actual census tracts, QOZB being Qualified Opportunity Zone businesses, the operating subsidiaries, and now, thanks to the Big Beautiful Bill, QROFs, or what some are calling RQOFs, Qualified Rural Funds, the new rural counterparts to QOFs. Next slide, please. As background, the Opportunity Zone program was originally established under the Tax Cuts and Jobs Act in 2017 as a time-limited incentive to spur investment in low-income and distressed communities. The basic idea behind the Opportunity Zone program is that there are many communities which traditional capital markets either ignore or underinvest in because of perceived risk or low returns. By offering tax-based incentives, the program tries to encourage private market investments in those places to generate jobs, economic growth, infrastructure improvement, and so forth. The initial tax benefits are threefold. The first benefit is deferral from not paying tax on gains invested in a qualified opportunity fund. The second is a partial exclusion of tax, to 10 to 15% reduction in the deferred gain, depending on the holding period for the investment. But this benefit was lost over time, however, and has not been available since 2022, which is part of the reason the OZ program is losing steam. And then the third and primary benefit is the permanent exclusion of post-investment appreciation for investments held more than 10 years. Next slide, please. As enacted by the Tax Cuts and Jobs Act, there were two sections in the Internal Revenue Code relating to opportunity zones. One that details how the opportunity zones were selected, the mapping and certification process led by state governors and treasury, and the other being providing the mechanism for the tax benefits. Now, under the Big Beautiful Bill, opportunity zones live throughout 5 sections of the tax code. And with that foundation in place, I'll hand things over to Andy. Next slide, please.
Thank you. And yeah, for the next slide. Again, thank you, Trey, and apologies for having my microphone off of mute. You can all hear my water bottle crinkling. Appreciate the introduction. And yeah, I think Trey and I are giving this presentation today because this is one of the most exciting, now permanent, and it was exciting when it was implemented back in 2017, additions to the tax code. There are very few sections of the tax code and in the investment world that allow for a permanent exclusion of gain. And there are two primary benefits to these opportunity zones. But again, this is an exciting tool that investors in real estate or business can use. So with that, I'll step into the overview of the initial legislation, which came about in 2017 with rulemaking and designation of the initial zones in 2018 and 2019. As an overview, an investor who realizes capital gain, and that's the threshold issue. You have to have capital gain, and you have to invest it in 180 days. Now listen, you don't have to go from realization of capital gain to a ready to produce widgets project in 180 days. You have a substantial amount of time to do that. But that's it. That's the start. You must have capital gain. So an investor who invests in a qualified opportunity fund that invests, directly or through one of its subsidiaries in property located in a qualified opportunity zone can take advantage of deferral of the capital gain and over time, a full elimination of their long-term capital gain on that project in which they invested. So step one, the investor realizes capital gain. And realization is essentially the common description. It's the date of sale. And that gain can be from anything. It can be from the sale of a business, the sale of stock, the sale of crypto, baseball cards and art. That's how deep it goes. It's from anything. And it can be short-term and long-term. Step two, the investor timely invests, and that's 180 days in the qualified opportunity fund. Step three, the fund invests in the qualified opportunity zone property. That's where it gets complicated. I hate to say it, that's where you need a lawyer throughout all of this. But the complication there is where you need a lawyer and you need an accountant. And of course, the property must be located in a qualified opportunity zone. Next slide, please. There are essentially three benefits. There's the deferral of the tax you should have paid on the capital gain, the exclusion of some of that when you ultimately do pay it, and then the potential permanent exclusion for the project on what you invested it into. Next slide, please. Let's start with the tax benefits. So the taxpayer defers paying tax on eligible capital gain once the investment is in the QOF, and then the QOF makes the investment in the opportunity zone. There are, of course, IRS-based forms that must be utilized. They're not terribly complicated, but the detriment for messing them up is, invalidation, and you have to pay the tax earlier and potentially penalties. The initial basis in the qualifying opportunity fund is zero. There are tax benefits implemented through other basis rules. And then the deferral ends. We are in an odd period right now where the gain must be recognized. It's the earlier of December 31st, 2026, or the actual or deemed disposition of QOF investments after December 31st, 2026. And with the One Big Beautiful Bill, some of that changes. And then the benefit of that is, and we'll go through some examples at the end, tax you should have paid now that you have to pay later. You realize the time value of that money. If you put it in a treasury for 5 years and it makes cumulative 25%, that's a 25% gain on tax you would have paid. Next slide, please. Currently, up to 15% of the deferred gain invested in a QOF could be excluded from taxation. It's depending on the holding period. Now it's 5 years. You realize a 10% reduction, and then 7 years, which is an additional 2 on top of 5, you receive an additional 5% reduction. Again, these are under the existing rules. Given today's date and the expiration on 2026, it's going to be hard to take advantage of the new 7 years. And that went away in the One Big Beautiful Bill, but we'll get to that when we talk about the changes. Next slide, please. They're both big, tax benefits, but this is a huge one. If you hold a QOF investment for 10 years, the investor may elect to increase the basis of the investment to its fair market value at the date of disposition. That's the sale. That's to say, if you have 10 million of capital gain and you invested in a property, and after 10 years you sell that, and this is oversimplified, but you sell that $10 million piece of property, and there are other requirements, of course, for $20 million. That $10 million of gain that you realized going from 10 million to 20 million is totally tax exempt. That's where I say there are no better benefits in the tax code. Could we move to the next slide, please? So what is a qualified opportunity zone? The term is, they're basically census tracts of low-income communities, which the alphabet soup is LIC, and they're designated by the U.S. Secretary of Treasury with a lot of input from the states. A low-income community is a census tract that has a poverty rate of at least 20% or median family income that is does not exceed 80% of the area's median family income. Under the existing rules and the initial rules, contiguous census tracts could qualify. And then all census tracts in Puerto Rico are automatically designated as qualified opportunity zones under the existing rules. Next slide, please. This is the method by which they were designated, and will likely be designated again. The governors, they nominate up to 25% of eligible census tracts in each state, and the Secretary of Treasury certifies those tracts, and then they are published by the IRS and Treasury as opportunity zones. Next slide, please. So qualified opportunity zone basics. Utilize an LLC and individuals may do this too, but it's generally domestic corporations or partnerships. I cannot imagine a client who we would not advise to form an LLC to do this. It's a self-certifying process with the IRS. There's a form, and that's where I say it's relatively simple to fill out, but have your legal professional and your financial professional oversee that process, because you do not want to mess that up. So the entity, at least 90% of its assets must be in qualifying property, measured semi-annually. There are a couple of legal ways to accomplish that, and that's tested twice a year, once on January 1st and once on July 1st. So 10% of the QOF's assets need not be in the opportunity zones. I've generally advised clients against that. Why mix the good with the bad and overcomplicate things? But in the event there's a business purpose for doing so, you may do so. And then these qualified opportunity fund, which again, the QOF is your entity that you form. Can't participate in the opportunity zone program directly through ownership or indirectly through a subsidiary. I've seen it done both ways. My personal preference is to have the QOF be the operating entity, but for business and taxation purposes or planning purposes, I've seen it done the other way. where the QOF is an intermediary entity between essentially the holding company or the management company. There's the QOF, and then there's the operating entity below. Again, it can be done both ways. I have a preference, but business interests may dictate otherwise. Next slide, please. So with the One Big Beautiful Bill signed into law in July of this year, there were changes. We'll start with the reason why those changes were necessary. Next slide. The big one, and I think this is the most important one, is this was going to sunset on December 31st, 2026. Having done this since 2017, 18, 19, to oversimplify and colloquialize this, they just became less cool. As the time period shortened, they were extremely exciting in 17, 18, and 19 because you had this 5-year runway and the 7-year runway. Here we are in 2025, but in 2024, 2023, once you got within 5 years of 2026, it just became less fashionable. I would never have deemed myself an opportunity zone lawyer because there was not a sufficient interest in opportunity zones before the One Big Beautiful Bill. Now they're a permanent part of the tax codes, and absent repeal, they live forever. Long-term planning was a problem. The short time limit, you couldn't change the zones. And then we suspected this, I think, when these zones were published, but there was an urban bias. Now, for companies that invest largely in urban areas, this was great. But the current administration, one, saw this as somewhat of a weakness. And then two, I think the current administration was looking to somewhat reward its rural base. But, politics aside, I think you can argue the urban bias existed and this needed to benefit some of the rural communities. Next slide, please. So here we are, Opportunity Zones 2.0. This is what the OB3 or the One Big Beautiful Bill or OBA, however you want to say it, did. Next slide, please. Again, sunset was repealed. They did tighten the eligibility for the Opportunity Zone status. And then, of course, given that this lives forever, there needed to be a process to designate and redesignate these zones. Now it happens every 10 years. The tax benefits were slightly modified, and you can read slightly modified for non-rural areas. And then there are new benefits for the rural projects. And I would say those benefits are substantially better. And we'll get into that. Essentially tripled the benefits for rural areas on the deferral. And then good news for lawyers, bad news for business people. There are increased reporting obligations for the qualified opportunity funds, the entities, the qualified opportunity zone businesses, and then Treasury, which means the taxes that need to be filed. Next slide, please. So as we've touched on a few times, prior to OB3, the opportunity zone tax benefits, it just expired in 2026. So the benefits were getting ready to die. So July 4th, 2025, when OB3 was signed, we were down to 18 months, and the usefulness had essentially not died, but it was on life support. Now that sunset has been repealed, and again, these are indefinite. This is a permanent part of the tax code. These are permanent benefits you, your clients, your companies can take advantage of. Next slide, please. So let's get down to the details. Low-income communities, these census tracts have been more narrowly defined. The census tracts qualify if the poverty rate is at least 20% and the median family income does not exceed 125% of that of the surrounding areas. Now here's the or the median family income does not exceed 70%. That 70% was previously 80%, which made it easier to qualify of the area median family income. OB3 repealed the continuous tract rule. That continuous tract rule allowed governors, Treasury, interested political parties, lobbyists to say, hey, I know this tract doesn't qualify, but I'm over here. I have an interest in this area. We would like to see it developed. Can we get it designated? that lobbying designation, whatever benefit is no longer available. Then there's an automatic designation for low-income communities in Puerto Rico, but they must follow the same nomination and designation process as others. Next slide, please. What are the results? Fewer census tracts will obviously be eligible for designation, and then some current QOZs may not qualify for redesignation in the future. We're seeing it. I think we know the answer, but the question is, what if I invest now in a QOZ with my QOF? What happens to me? We're starting to see some answers. We can speculate on that, but more guidance is forthcoming from Treasury and the IRS. And then the stricter requirements, it must be a more impoverished area, less qualify. Next slide, please. Now, obviously, with a bill that lasts longer than 7 years, in fact, into perpetuity until repeal, we have to be able to make changes to these zones. It occurs every 10 years, and we're in a 2-year overlap right now. The first round of QOZ designations are now effective through December 31st, 2028. The second round of designations will become effective on January 1st, 2027. So essentially in 14 months. The IRS and Treasury are working to provide guidance as to some of the issues of the overlap, the sunsetting, the grandfathering of some of those. Next slide, please. And then tax benefit modifications. The tax benefits have now been modified to align with OZ permanence. OZ1 tax benefits now through December 31st, 2026. And then OZ 2.0 from OB3 from the One Big Beautiful Bill, those apply after 2026. So again, navigating the period between now and December 31st, 2026, it requires a deep understanding of the rules, some business strategy, and a substantial amount of legal and tax strategy. Next slide, please. Now we have the rolling 5-year deferral with Opportunity Zone 2.0. So 5 years out, it is now 5 years after the date of investment to take advantage of the 10% exclusion on your tax. And we will walk through some examples of this at the end to show you how this works with real world numbers. So it's the earlier of that, or if you when you actually sell or dispose of the property. Partial exclusion, again, 5 years, a 10% reduction of tax. And then there's no change for non-rural projects, but there's a substantial benefit change for rural projects. And then they repealed that additional 5% for the period between 5 years and 7 years. That seemed to confuse people. If you held something for 5 years, you could defer 10% of the tax, and then in an additional 2 years, you can defer an additional 5%. Obviously, a 15% deferral is better than a 10% deferral. That's now gone, but I think the benefit of the permanence outweighs that. And the 10-year tax benefit was modified to deal with the permanence of the opportunity zones. You must hold it for 10 years, and then you may elect, and it's essentially from 10 years to 30 years. Now, if you hold something for 30 years or more, there are ways to take advantage of it. And then there was a previous cutoff of 30 years after the Tax Cuts and Job Act. So that was that was 2017. That was 2047. Now it's 10 years and 30 years rolling into the future. If the election is made in year 30, any subsequent appreciation may be subject to tax. Hopefully, some or all of us will be here 30 years from now and helping guide clients through this. But as you're advising clients of the benefits of this now, you need to understand that. And the next slide, and I believe I'm going to turn it back over to Trey at this point. Thank you.
Thanks, Andy. So, as Andy's alluded to, so in addition to making Opportunity Zone permanent, the Big Beautiful Bill adds substantial benefits for investments in rural areas. This is in response to some of the louder criticisms of OC 1.0, which was that investments largely flowed to downtown urban areas, little capital going to rural areas. Which when you think about some of the risks that might be associated with rural investments, such as smaller markets, infrastructure constraints, and fewer exit opportunities, that kind of made sense. So in response, the big beautiful bill is now is trying to level the playing field and actually shift things where they might be more beneficial for rural developments. So now with these new rules, there's now a new concept called qualified rural opportunity funds. There's an enhanced basis step up and relaxed substantial improvement test. Next slide, please. So what counts as rural? Rural areas are defined as any area other than a city or town with more than 50,000 people, and any adjacent or contiguous area next to a city or town with 50,000 people or more. Essentially kind of trying to take away, large downtown centers and then right around them, basically trying to push you out the rural areas. So there was a question over what is an urbanized area. That's in the statute. But then right before the government shutdown began, Treasury and the IRS published Notice 2025-50, which listed approximately 3,300 existing opportunity zones that are comprised entirely of areas meeting the definition of rural areas. And in that notice, the Treasury and the IRS, they kind of walk through their methodology for how they're determining what constitutes a rural area, what's urbanized, et cetera. And it kind of like shed some light on the way they are looking at that while we are in this interim period between statutes being enacted and regulatory guidance being formally issued. The reason that the Treasury and the IRS released Notice 2025-50 was because of one of the effective dates that we'll get to in a moment. But so one of the benefits for rural areas is this relaxed substantial improvement test, which went into effect on enactment of the Big Beautiful Bill on July 4th. So basically, the IRS kind of knew that they needed to get some guidance out there because that benefit applies to existing projects. So next slide, please. So as part of the Big Beautiful Bill, there's a new concept that was added for rural opportunity funds, which is essentially just a subclass of opportunity funds that receive more generous tax benefits. The rural fund concepts, they generally follow existing QOF principles, except that to qualify as a rural fund, 90% of the fund's assets must consist of property located entirely within a rural area. Again, that's kind of part of the reason why IRS notice was issued, is to figure out what is a census tract that is entirely a rural area. And so that's kind of what the 50-page notice kind of delves into. From a policy perspective, these rural funds are aimed at creating dedicated capital pools for rural projects, since they have to kind of focus solely on rural projects. Next slide, please. So the primary tax benefit for investing in a rural area is that qualifying investments in rural funds that are held for 5 years receive a 30% basis step up rather than a 10% basis step up for non-rural projects. So compared to non-rural projects, rural projects get a triple the benefit, which is pretty substantial. When you think about what is a rural area, such as where data centers are being built, distribution centers are being built. These are not just small downtown areas.
From a personal perspective, I have to say energy projects too. Sorry.
Energy projects as well. Yeah. Yes. So, I mean, one way to look at this from a policy perspective is that Congress wanted to compensate for the higher risk and lower liquidity in rural projects by sweetening kind of the midterm benefit at 5 years. That's the primary enhancement to the benefits. Next slide, please. So that if that's the enhancement of the benefit, there's the corollary of that is that they also the Big Beautiful Bill also lowered the barrier for rural developments. So some of you might be familiar, but for OZ projects that involve pre-existing buildings and structures, there's something called the substantial improvement test that generally requires that the basis of property of the existing buildings and structures be doubled within a certain amount of time. So basically, if you purchase a building for $80, you have to invest another $80 in it to qualify to pass the substantial improvement test, which is one of the primary hurdles when you're dealing with rehabilitations. And that rule remains the same for non-rural projects. But for rural projects, next slide, please. The Big Beautiful Bill relaxes this rule. And so for projects located entirely within rural areas, the substantial improvement threshold is lowered to 50%. So for your $80 building, you only need an additional $40 of investment to qualify. So, if one thing that's kind of a common theme for these rural enhancements is that they have to be entirely within rural areas. And so I guess one guidance is expected to kind of clarify what happens when you've got a project that straddles both a rural area, but it's not entirely within but the project itself is not entirely within a rural area. We would expect to kind of see that answered in due course. Another thing to note for the reduced substantial improvement test is that it does not require the involvement of a rural fund. It just looks to where is the asset located. That is it. And then as I kind of previously mentioned, this relaxed substantial improvement test, it's already gone into effect. So it's already live and applies retroactively to ongoing rural projects that have not completed construction, which was kind of confirmed in the IRS notice when they said that, it applies to all projects that have been or are in the process of being substantially improved as of whatever date of determination. It's pretty favorable guidance, and it kind of clarified some things because, as we'll get to, there's probably at least half a dozen differing effective dates for these rules, and this would be the primary one that's already effective. Next slide, please. So now shifting gears to the most criticized aspect of OZ 1.0, which was the lack of transparency. After the Tax Cuts and Jobs Act, critics were quick to point out that, for one, some of the contiguous tract rule kind of led to targeting of OZ selection criteria. But then two, another big criticism was that there was no public data to show whether OZ was working. There's no way to measure whether the investments actually helped the communities they were supposed to serve. The only real standardized reporting in OZ 1.0 was through the form 8996, which is the tax compliance form that QOFs annually file to self-certify whether they've met a 90% asset test. The form doesn't tell you anything about what the investments are actually doing. There's no business activity data, no employment or jobs data, and no way to track the flow of capital by industry. So from a policy standpoint, the opacity of the lack of reporting made it impossible to evaluate whether OZ was achieving its intended goals, and then led some skeptics to even say, if we can't measure the benefits, maybe they don't even exist. Next slide, please. So the Big Beautiful Bill directly responds to those criticisms and largely enacts a 2019 proposal that kind of imposes a comprehensive reporting regime that applies to funds, the businesses, and the even Treasury Department itself. So for tax years beginning after July 4th, 2025, so, next year for most, there is now a clear reporting framework where the qualified opportunity funds, they report detailed asset and investor data. The qualified opportunity businesses provide corresponding information upstream, and then Treasury compiles it all and annually publishes reports. And to make all this work, the Big Beautiful Bill also added a significant penalty system for noncompliance. Next slide, please. So So the new code section 6039K is kind of the backbone of the reporting system. But it's imposed on the fund, but as we'll see, the businesses themselves also have to provide this information. And from a practical perspective, it's a whole lot more information than businesses and their investors were used to exchanging when it's a passive investment. And so this will kind of change the dynamics a bit. So this new code section, which will be implemented through regs, it expands the fund's annual reporting obligation to requiring basically disclosure about the fund's investments, who, where, and what the fund invested in. And it requires funds to essentially look through their investments when they're reporting, as applicable, basic entity information about the fund itself, as well as their QOZBs, their name, address, entity type, taxpayer ID numbers. But they also require the funds to report their semi-annual value of the fund's total assets, as well as the semi-annual value of the fund's total OZ property. So two different values going on when you've got a mixed fund. For the fund also has to report for each qualifying business in which it invests, the QOZB's name, NAICS code, census tracts, dollar value of investment, property values, leased property valuations, average monthly full-time equivalent employees, residential units, and a number of other things. And funds are also required to annually report which of their investors have disposed of interest in the funds during the year, as well as their name, timing of investment, acquisition and disposition, and dollar amounts. Further, the fund also has to give investors copies of the information that the fund itself reports to the IRS about the investor. So this is a completely and totally new reporting regime that will kind of change the dynamics of investors, funds, and businesses. But they all kind of go towards the policy goal of requiring funds to report standardized data so that Treasury and various other parties can map investment patterns and analyze the types of projects and industries that are receiving OZ capital and producing jobs and opportunity zones. So and presumably it'll cause further recalibration of the statutes over time. Next slide, please. So as I mentioned, the fund itself can't report what it does not know, and so there's also a new corresponding section for opportunity zone businesses that pushes the obligation to report downstream to the QOZB. So basically the QOZB is required to provide the same info to QOFs that the QOFs have to provide to the IRS. But it's worth kind of pointing out here how so we're about to get into the penalties, but the penalties only apply to the fund. They don't apply at the QOZB level. And so, kind of as you see in two-tier structures currently, there's you often see in the partnership agreement or operating agreement, there's a mechanism where the QOZB has to report out on compliance with the OZ rules, and then there's contractual assurances that they will do so, and then there's indemnities or other risk mitigation provisions to kind of make sure that the QOZB does so. And so because even after the one big beautiful bill, the penalties are still imposed on the fund, and so the fund still is at risk for paying a penalty due to the business's non-compliance. The fund will still kind of want to negotiate with its underlying businesses to make sure that the partnership and operating agreements still contain similar language to kind of protect themselves. Next slide, please. So as I mentioned, there's a penalty regime to make sure that participants don't disregard these reporting obligations. And these dollar amounts on the slide, they are indexed to inflation, and so they'll be increased annually. But essentially, the failure of a fund to file a complete, correct, or timely report triggers a $500 per day penalty, capped at $10,000 per annual return, or $50,000 cap for large funds with assets over $10 million. So potentially a pretty substantial penalty if you just completely if you ignore it, but then if you intentionally disregard it, the penalty jumps to $2,500 per day, with caps of $50,000 for small funds and $250,000 annual caps for large funds. Next slide. So continuing on with the regime. So once the Treasury has the data from the funds and the businesses, the Big Beautiful Bill next obligates Treasury to annually publish that information, beginning as soon as practical after July 4th and annually thereafter. And Treasury is kind of required to aggregate the data at first and just report raw numbers where, number of funds, aggregate asset values, OZ investments by NAICS code, percentage of zones that have actually received investment, employment data, the split between real property and other property. And then there does seem to be a focus on apartments because you have to report out, the Treasury has to report out the number of residential units attributable to OZ investment. And rural funds have separate reporting reports. Next slide. So, beginning in 2031 with the sixth report, Treasury have to go beyond just raw numbers and start actually analyzing it and provide economic impact analyses that look at job creation, poverty reduction, business formation, and other metrics. In year 6 and 11, Treasury is also required to report OZ tracks versus non-OZ tracks, and then pre-OZ and post-OZ. So they're really Congress is really kind of imposing some obligations on all participants in the program to see if the program actually works and if it's meeting its intended goals in reducing disparities in underserved areas, or is it just reshuffling investment patterns, just to chasing the benefits? And so again, if these reports clearly show that OZ is failing to lift local economies, then, as I mentioned, presumably Congress will respond and recalibrate and change OZ again with OZ 3.0. Next slide, please.
Thanks, Trey. Appreciate it. I'm going to touch now on the transition period, and then we're going to move into some, example transactions or some hypothetical transactions. So the transition period is now between now and December 31st, 2026, which is 14 months. Next slide, please.
As mentioned, as mentioned at the beginning of the webinar, we take a brief moment to satisfy CLE requirements by delivering the following code word. All Kansas, New York, New Jersey, and Pennsylvania licensed attendees must type the code word opportunity into the Q&A section of your screen. Please make sure to hit the send button so that it registers. In case you missed it the first time, the code word is opportunity. Next slide.
Thanks, Trey. I appreciate it. And sorry for stepping on that. So during this transition period, importantly, there will be a new 10-year QOZ designation. The process is generally going to be the same. The state governors nominate, the Secretary of Treasury will certify, and then it will designate and publish the list of opportunity zones. Last time, there was not a substantial amount of pushback from the Secretary of Treasury. It remains to be seen whether there will be this time. It's the same president, but a slightly different administration. So that's to be determined. The nomination window will open on July 1st, 2026, and then, given its permanence, it will reopen every 10 years thereafter. The zones will be designated and effective January 1st, 2027, and every 10 years thereafter, January 1st, 2037, 47, 57, and then they expire, obviously, the date preceding the effective date of the new designations. Next slide, please. So for round one, qualified opportunity zones, that was 8,764 zones. And those designations will remain in place until December 31st, 2028. They've given a little bit of an extension here, given the new effectiveness of the bill. Next slide. Here is a very useful timeline. It shows the opening of the nomination on July 1st, 2026. The designations and when they go into effect on January 1st, 2027. The expiration of the current designations, and then the moving forward basis every 10 years thereafter. There's the first example. Next slide, please. And here is a list of the effective dates, the process starting, the end of the automatic designation for Puerto Rico, if you have clients, businesses down there. New eligibility criteria, that, as Trey indicated, went into effect immediately upon execution of the bill. And then there's the overlap period of 2027 and 2028. And then the designation period, and then the substantial improvement test for rurals obviously also went into effect upon execution of the bill. And then the effective date of the new reporting requirements, likewise, July 4th, 2025. Next slide, please. All right, now it's time for a few hypothetical transactions. These will show in real dollar terms the benefit of this. So if we can move to the next slide. This is a traditional opportunity zone, and I say that in contrast to the rural opportunity zones. So let's say we have an entity, Acme. They realize a $10 million capital gain, as I said, from any source: baseball cards, art, more likely stock or the sale of a business, and maybe crypto. It's a brave new world. That entity forms a qualified opportunity fund in full compliance with the law, and places the $10 million into the QOF's account within 180 days. Within an additional 180 days, Acme and its QOF subsidiary, and there are, as I mentioned, I think in my first speaking round, there are alternative structural requirements, but you do have to have the QOF subsidiary in the chain or in the org chart. It allocates that $10 million, or it develops a written plan to allocate that money within 31 months. And that's what I touched on earlier. You don't have to have a project within 180 days or 180 days plus 180 days, rounding that to a year. You can come up with a plan, and it's a 31-month plan to allocate that money. So if you add that, it's 180 days to allocate the capital gains into the QOF, 180 days to come up with the plan, and then a 31-month plan. You could hypothetically extend this out to 41 months. And so the theoretical here is that it allocates the $10 million into an energy project. Again, that's close to my heart and prompted me to interrupt Trey to make the shameless pitch for energy projects. And then Acme uses that $10 million to ultimately develop a $10 million with $1 million allocated to land, $7 million to fixtures, and $2 million of personal property utilized within the project. I'll touch on very briefly here something that we mentioned but not delved into too much. There are two additional, I call them big requirements. Obviously, we've seen the list on this slideshow that Trey discussed. They are exceptionally long requirements, but the two big business requirements are that it must be an active trade or business. You can't just go in and buy somebody's business and say, hey, I've developed, I've used my opportunity zone capital gain and purchased a new business. If it's not new, it doesn't qualify. Now, are there ways to nuance that? Yes, there are. And then the substantial improvement test, which Trey focused on deeply. Let's say you buy a business with a $1 million piece of property that's land and building. You don't have to meet the 100% requirements, or in a rural area, the 50% requirement, improve it by $1 million, or again, in a rural area, half of that. It depends on the allocation of that between the land and the existing building. And from a real estate or even an active business perspective, do you have to meet this requirement? Absolutely. Do you need to worry about meeting this requirement? Absolutely. From a business perspective, it's not going to be the most difficult to meet because you invested in this property. You're probably going to invest more into the business, but to the extent you don't, you may not be able to take advantage of the law. Back to the hypothetical. So Acme ultimately develops a $10 million project, $1 million of land, $7 million in fixtures. And that's another important point. This isn't just land and buildings, it's servers, delivery vehicles, manufacturing equipment. All of that can and is subject to opportunity zones. You just need to study the law and make sure it complies. And then $2 million of personal property. That's a total of $10 million. The project commences operations on May 1st, 2029. Acme operates it, makes money off of it, and it pays its taxes on the money it makes in that business. But then in 2039, Acme decides to sell the business for $25 million. Next slide, please. So here are the benefits. In 2026, Acme should have paid $2.1 million in tax, which is using the 21% tax on its capital gain of $10 million. That payment is deferred for 5 years. The current 10-year treasury rate, when we wrote the slide up, it's 4.2. I think it's down a little bit under 4 now, but give us the benefit of the doubt. So 4.2. On that $2.1 million tax bill, Acme saves $472,000 or $472,000. At the time it makes the payment, it realizes the 10% reduction. That's another $210,000. Add those up, you get a $682,000 tax savings on a $2.1 million bill. That's over 25%. It's a substantial benefit that is on par, if not better than the number of those in the tax code. And that's just a lesser financial benefit. So then Acme sells this $10 million investment for $25 million. Acme has $15 million of capital gain. I cannot emphasize this enough. Acme pays no tax on that $15 million gain. Acme's tax avoidance on the $15 million gain after 10 years, and it's up to 30 years, is $3.15 million. The total savings, that $3.15 million plus $682,000, is $3.83 million. Those are the benefits of this law on a $10 million capital gain invested. And I get it. Are you going to 2.5 times your investment over 10 years? It's not unprecedented. In fact, I would say it's common in a number of industries. Next slide, and we can talk about the rural zones. Here's the rural zone scenario, the base facts. It's substantially similar. I've shown the differences in italics. There's the $10 million of capital gain and invest. Acme forms a rural QOF, the RQOF, and places its RQOF, it's $10 million into the account. Then with 180 days, it allocates the $10 million or develops the plan. Develops the same project, realizes the same gain. Next slide, please. And here's the big difference. The payment of tax is still deferred for the same amount of time. You still realize the same benefit of that. It's the third bullet point, which is the big one. The tax is not reduced by 10%. It's reduced by 30%. So that $210,000 reduction of tax turns into $630,000. And then the fourth bullet point really drives this home. The total savings over 5 years through the Opportunity Zone program, $2.1 million of tax is reduced by $630,000, again, as opposed to $210,000, and then the same time value of money. That's a $1.3 million savings on what should have been a $2.1 million tax bill. And you can see the benefits; they're self-evident. And then you just add that to the $3.15 million of tax savings it realizes by not having to pay capital gains. And you have, on a $10 million investment, a $4.4 million savings in the Rural Qualified Opportunity Fund. Next slide, please. Now it's time for Q&A. Feel free to submit them in the chat. Someone on our team will get back to you, and we have 5 minutes, I think, if we're able to access that. We're happy to answer them.
Yeah, I don't believe we've received any questions yet. Um, so Andy, what kind of OZ deals are you seeing now with this new program, and how are you planning for, the next 18 months?
Um, we're seeing some funds, some individual investors, um, and just some people who have manufacturing projects that are coming online. To the point that and I think the slide presentation is largely his. So he deserves all the credit in the world for that. The point your slides make is we're in this overlap period, so they're stressing about that, trying to figure out how everything's going to work, trying to navigate that. Um, some of them are, in rural areas are saying, what do we need to do to get ready? And then some of them in existing areas are saying, what do we need to do to make sure we take advantage of that now? And then to the extent they're unsure what they want to do, they're saying, when is the best time to invest and what do we need to do to get there?
I had one client recently who they were considering an investment in an area that's currently a qualified opportunity zone, but when you start applying the new median income test and the new stricter criteria, it became apparent that the place they were looking to lease will no longer qualify after the designation expires. Um, and so our advice in that instance was to try and negotiate with the potential landlord to see, can you have an exit right, which may or may not make sense in some cases. But for the next 18 months or so, there are going to be a bunch of weird questions, and especially with respect to commencing investments now versus under the future regime, because in theory, if people were to realize a capital event in 2026, you could, depending on the circumstances, for example, whether it's realized within a partnership or not, you could potentially defer the OZ investment until 2027 to take advantage of the new rules. So we're kind of in a weird time right now where you've got some multiple things to look at with a lot of uncertainty, but you can kind of make an educated guess based on current guidance, such as was the case for um, uh, how long the current OZ designations remain in effect, which at first, like in July 10th, it was a little unclear. And then eventually it kind of came clear, and then IRS notice 2050 kind of confirmed that.
Hey, Trey, we have a couple of questions in the chat now.
Okay.
The first one, I'm going to say I think no, but I would like your input on it, Trey. And at a minimum, I think we need more information. And it's, can I invest capital gain in 2025 and liquidate the OZ investment in 2026 and invest in another fund in 2027 to get 6-year deferral of this year's capital gain? It's every person's least favorite answer is maybe. My inclination is no, but it's possible. We need to know the specific facts around that. Do you have any thoughts on that?
Yeah. There in the final regs that came out in 2019 and then were then kind of expanded upon during COVID, they have this anti-abuse rule that focuses on circular flows of cash. And so basically, can you yourself trigger a capital event to take advantage of the OZ rules? And so, under the fact pattern posed, it's a little bit unclear because we'd have to know what was the capital gain event giving rise to the liquidation in 2026. But there are some pretty tough anti-abuse rules, and so I would be when you're trying to self-trigger timing event to adhere to timing rules, I would seek guidance.
Yeah, I would seek guidance too. That is going to be heavily fact specific. Next one is a little bit easier. Benefits and downside of opportunity zone versus 1031 exchange. They're different programs. Ultimately, at the end of the day, in a 1031 exchange, you roll over your gain, roll over your gain, roll over your gain. But at some point, you're going to have to pay. In an opportunity zone, at some point, you will have a full exclusion. If you realize appreciation, you will have a full exclusion. But they are totally different programs, totally different benefits, totally different requirements.
One of the
Yeah,
big
they
differences between OZ and 1031 is that with 1031 you have to invest your principal and your appreciation. With OZ, it's just your capital gain. It's a little
yeah,
bit different of what you have to put in. And
that's absolutely right. Um, well, we are at time. So let me get through our closing. Thank you again for participating in today's webinar. In approximately 30 days, you will receive an email with a link to your CLE certificate. Your webinar login deals will be used to process these certificate. No additional steps are required on your part. As a reminder, the code word requirement is only if you are seeking credit in Kansas, New York, New Jersey, or Pennsylvania. Have a great day and feel free to reach out to either of us if you have questions or would like to talk about this more. We're happy to do it. Appreciate everybody and have a good rest of your day.